Hello everyone, Corey here. Let's discuss today the topic of venture capital financing 101. So, what is venture capital financing? Well, let's start with the last word first, financing. So, how can you raise money? You can raise money from friends and family. You can raise money from a bank via a loan. You can raise money from private equity. Generally, private equity refers to medium stage businesses from their life cycle. These would be mature industries, mature businesses. And then there's venture capital, which is a subset of private equity. And what that just means is it means an investment into a company that is at an earlier stage. Typically, you're referring to a high growth, also high risk early stage company. In modern times, meaning the last 15 or 20 years, you really are referring to what you think of as your big tech companies, Facebook, Apple, Google, etc. And so in that space, venture capital financing refers generally to the idea that you've got investors that are specifically looking to invest capital into the next big hit success. So this could be a company that goes to an IPO or a company that becomes an acquisition target for a larger company like LinkedIn and Microsoft as a perfect example. So that's a high level what we're talking about. And then if we go further into the topic, you think about, well, who might be a target for venture capital? So industry-wise, I would say there's no one specific industry that may be a target for venture capital. Historically, it's been high growth tech companies. And I would say that high growth prospect is probably the key component. Outside of that, you could theoretically have any number of business types that receive venture capital, as long as the business has the opportunity set to have high growth. So you could be a high growth coffee company, a high growth soft drink company, a high growth software as a service tech company, or just a high growth business of some other fashion, and potentially venture capital will be interested. The main questions that they're going to think about is whether or not you, as the founder and the business or the industry, has the potential to be that high growth type of industry. And so that's generally what venture capitalists are looking for when they talk to folks. So as a founder, one of the interesting questions as a founder is actually, should you take venture capital? And I'll briefly touch on that and kind of end it after that. The question of whether or not you should accept venture capital, you have to understand kind of what you're signing up for. So when you think about venture capital, a venture capitalist is giving you cash in exchange for a portion of your business. So that portion can range in size as far as percentage and check size, but conceptually, if you think about it like you're on a hamster wheel, once you accept that cash from a venture capitalist, you've now given up some equity in your business in exchange for their capital and hopefully some sort of mentorship or additional strategic value to help you grow your business. And once you do that, though, you are now on the hamster wheel of thinking about or having to raise additional capital every 18 to 24 months. Because if you are truly a high growth company and you're truly trying to grow at the levels of which the venture capital mandate was attractive to you, most likely that's going to mean that you're going to need additional funds. And so it's not as simple as saying, let me accept capital from an investor right now, and then it's a one and done. It's really a longer term relationship. So with that, we'll cut this and look to hear from you soon. Thanks.